This week's portfolio gave us more exposure to dragons. Hey, what's up? I'm Russ and this is Dapper Dividends out here in the beautiful Black Hills of South Dakota, the Deadwood region, on a family vacation. Took an RV trip out here from Chicago, hanging out, but it is time to get down to business and tell you about all the dividends and portfolio activity this week. First, we received $104.92 from Altria. Now, a lot of people have a beef with Altria because it's tobacco products. It is a sin stock, but they bring in a lot of cash flow, and I really don't mind investing in them personally, but that's a personal choice. Obviously, personal finance is personal, so that's going to be up to you. But they did pay us, all in all, $104.92. Now, this is across three portfolios. We have the self-directed IRA, the bridge account, and the Roth account, which the Roth and the self-directed are tax-advantaged accounts. Next up, the big pharmaceutical conglomerate Merck paid us $7.15. Haven't been buying much of Merck lately. I've been directing more toward Johnson & Johnson, but Merck, AbbVie, and Johnson & Johnson are by far our three most favorite pharmaceutical stocks. $1.60 was received from Chubb, ticker CB. We only had 2 shares and we did sell those off so we could roll that into the bank stock JP Morgan. Check out the video right here that we did on JP Morgan, which was included in the bank stocks that we have been buying, and why I like the banking sector and I think it is undervalued. One thing to keep in mind is that the dividends received on that were a much higher yield on cost. What you want to do is take your cost basis and divide that by the current dividend amount, and that's going to tell you your yield. Now, getting back to Altria, if you would buy Altria at $15, $16 a share back in 2011 or so, I believe that would be an over 20% yield on cost on those shares. Just phenomenal, the power of compounding, plus the capital appreciation that also goes on top of that. And then, of course, we received 10 cents from Weekly, the weekly dividend ETF. Using this to track it for the channel, because when you buy something, you have more skin in the game and you're going to pay more attention to it. So we received 10 cents from Weekly, and all in all, that was $113.77 of dividend income this week. And in the bridge account, we bought 1 share of Pepsi at $149.65, which was a 2.87% starting yield on those shares, which is really solid, over 2.75%. That added $4.30. Now we're adding 1 share every single week until we hit 100 shares so we can start selling covered calls. Now, the cool thing about covered calls, which is an option, is that whatever you sell it for, if I were to sell that option for $1 per share, I would receive $100, and that would lower our cost basis by $1. We started a position in Alibaba, ticker BABA. Now, many of the Chinese stocks have been way beaten down, and with good reason. They're risky, so I understand this is risky, and they're subject to the Chinese regulatory, the strong arm that China uses, because they can the government can unilaterally do things just on a whim overnight. Look no further than Didi, Dai, however you say it. Just waited for them to go public and then made them pull their app. Really, really risky, but we're still interested in Alibaba and still buying Alibaba. 48% revenue growth over the past 3 years. They are indeed the Amazon of China. Huge, crazy growth, over $1 trillion in annual revenue, and we're happy to keep adding more. I would fully expect to see them north of $300 in a year or two. And here comes the dragon exposure. In the Roth, we bought 2 shares of AT&T at $28.47 for a starting yield of 7.31%, which added $4.16 of annual dividend income. Now, here's the caveat. That is going to change when they complete the merger and then they spin off Warner Media with Discovery. That yield is going to drop precipitously, and it's probably going to be somewhere in the, what I've heard estimates of, the 4 to 5% range, which is still double the yield of the S&P 500. So we're A-okay with that yield, plus we receive shares of Warner Media. Now, more reasons that we're bullish on this is because of Discovery. AT&T was able to unlever a lot of debt that Discovery and Warner Media will be taking on, but I think that's okay because Discovery is a free cash flow machine. They have 18% year-over-year growth the last 5 years, except for that dip during COVID times. There's a lot of things I like about Discovery. They are responsible for 20% of all legacy cable, the bundle viewing, which the bundle cable viewing is obviously starting to go away, but Discovery is a powerhouse. Now, the Warner deal sees them taking on 5 times leverage, but they bought Scripps a few years ago, and I believe they took on 4 to 4.5 times leverage, and they wanted to get that down to 3 in about 2 years. They did it in a year, in under a year, because again, Discovery is a free cash flow machine, very well run. So I'm excited to see their nonfiction content. They have a lot of reality and documentary series, which is really cheap to produce. It gives a great return on capital. And now you're going to compare that with the universe of Warner Media, which is maybe only outmatched by Disney because of Marvel and Star Wars and everything, Pixar that Disney has. But everything that Warner Media has, the DC Universe, Warner Brothers, they're a powerhouse, and I am super excited to see what this new entity does. And the Dragon exposure does come in with Game of Thrones. Warner Media owns HBO, and there are, what I see, 5 proposed spin-offs. A couple of them are already in the works for Game of Thrones. So hopefully those gain traction and take off, but we're gonna get exposure to more Game of Thrones and more dragons. I think of a lot of price that's being discounted and beaten down is because of people expecting a big sell-off after the morning after the merger and spin-off goes through, and you have AT&T shareholders, which are buying for, maybe they want to own a telecom and they're buying for the dividends, that they're going to see that they have shares of this media entity, and they're just sell its equity that doesn't spin off a dividend, and it's not what I want. It's not in their wheelhouse. So I think a lot of people are just going to sell, and that could create a really great buying opportunity. And then on top of it, like I said, I'm really encouraged by the debt that Discovery has paid down in the past. And remember, when you're paying down debt, you're also building up shareholder equity, so you're increasing the value of the company, and it's just a matter of time that companies increase in value and the price is going to follow. And then we bought 2 more shares of a non-dividend growth company, one that I'm also excited about. I have been turning a blind eye to a lot of the growth companies in the portfolio. Now, we want maybe about 10%-ish of the portfolio in growth companies, because as Warren Buffett says, when companies don't pay dividends, you retain more of your earnings. And when you retain 100% of earnings, you can roll that right back into the business and grow the business even faster. And like we've covered, Warren Buffett is not fond of paying dividends. He's fond of receiving them. But when you don't pay dividends, you're able to pass that along to the investor by not having them to pay income tax on those dividends, because dividends, of course, are taxable. And those 2 shares were of Take-Two Interactive. Really great company because they make addictive content. They make video games. So Take-Two owns Grand Theft Auto, Red Dead Redemption. They own Rockstar Games. They own the 2K series, NBA 2K. And on top of all that, they've announced that they're going to release 93 new games over the next 5 years. Everybody's playing games. My kids are always playing games. And where are they playing them? They're playing them on mobile. I just saw, this is what pushed us over the top, after they acquired Nordeus Games, which is a mobile game manufacturer responsible for a soccer game that has well over 200 million users. And in 2017, they bought Social Point, and in 2020, they bought Playdots. So their mobile empire is expanding, and I think Take-Two is just a phenomenal company. Their balance sheet, incredible. They have no debt whatsoever, and their 3-year average revenue growth is 22%. They have a 17% return on capital, which is better than Amazon currently right now. So all in all, we added $8.46 of dividend income of Patty, projected annual dividend income, to all 3 portfolios. And lastly, we bought $50 of Ethereum at $2,127. Love Ethereum. I think the moat that they're building is only getting bigger. I think that Bitcoin and Ethereum are the 2 that are not going away. It's very risky for developers to build on some of these other projects that I love, because Ethereum is becoming the New York City or the Chicago Loop area, where all the businesses, that's where all the people are. Now you could build for much cheaper and be the only business available out in a desert, but are you going to get the traction? Are you going to get the people that are coming through to use your product or service? And I've said that Ethereum is like the internet. Well, I still think that's true. They are an operating system that is going to have many, many more developers built on top of it. And if you want to see this visualized, go to cryptofeast.info. Everything in pink is built on Ethereum there. And just look at the pink and everything that's being used on top of Ethereum. So Bitcoin is like digital gold. It was built to represent gold. And in many ways, it's better than gold because it's more transferable. It can be instantaneously audited. We don't know exactly how much gold that there is out there, but we will know exactly how much Bitcoin is out there. But Ethereum is like an operating system. It's what developers are building on top of. It is going to try to be the internet. So if you were to try and put a value on the internet, that would be crazy. And that is what Ethereum is trying to do. And that's why we keep buying Ethereum, because we're following the developers. There's a lot of other projects I like there. I like what OneChain is doing. I like what Cardano is doing. And I like what Algorand is doing. Those are their own separate blockchains. They're not built on top of Ethereum. We're going to keep buying it, and we're not going to stop until we start seeing an exodus of developers, because developers are staking their time, their money, their effort, their reputation, all on that operating system at Ethereum. And I think Ethereum and Bitcoin have moats that are just growing bigger every single day, and we're excited to keep investing in them. We're going to keep investing in AT&T as well, because we're excited for this merger and the spin-off of Warner Media and where AT&T is going in the future. So check out this video we did right here on a few AT&T stock predictions, and I will talk to you there.